Acharya's 2013 paper assumes that you could model the company and sector returns like a weighted average cost of capital. We say that the unlevered IRR is equal to the equity ratio times the equity IRR plus the debt ratio times 1 minus the corporate tax rate times the weighted average cost of debt. Next, you rearrange the equity ratio and debt ratio terms to get a common denominator as follows, and this gives us the equation that's used in the academic and industry studies. We will use this formula for our private equity deal and change the color to blue so we don't lose track of the terms. In green, we'll do the same thing with the returns of the sector, where IRR sequity will be the sector equity return, IRR sunlev will be the unlevered sector return, SDE will be the sector's debt to equity ratio, ST will be the sector tax rate, and RSD will be the average cost of debt to companies in the sector. These two equations form the basis of the academic models, so let's consider the numbers that we'll need to plug into these formulas. IRR equity is just the total equity IRR for the private equity deal. It's probably pretty close to the gross IRR on a GP's quarterly report or fundraising deck, although that may be a little bit off due to dilution of certain shareholders in the equity stack. The debt-to-equity ratio is something you may be able to estimate from capital structure data in a GP's marketing or reporting materials. Just note that the value changes when companies pay down debt, so you'll need to take an average of the entry and exit values. The company's weighted average cost of debt is probably something you'll need to estimate. Academic studies admit that they rarely have a real number for this. They usually just plug in LIBOR plus 300 basis points for the year that the deal was completed. Similarly, the tax rate is usually estimated from the location. For the sector equity returns, researchers typically use an annualized return from an index. Alternatively, you could take a PME type approach where you invest the private equity deal's cash flows into an index and measure the resulting IRR. That would be more accurate, but it would require more data and more work. You can estimate the sector tax rate from the company locations, but for the sector debt to equity ratio and the sector weighted average cost of debt, you probably need to build a comp set to analyze the companies that make up the index. Here, you likely need to leverage a commercial data provider like S&P Capital IQ, Bloomberg, or PitchBook. All right, once you have gathered all this data, we can get to work. We let the private equity deal's total equity return equal the sum of 1. Private equity alpha, which is equal to the difference between the unlevered return for the private equity deal and the unlevered return for the sector. 2. The sector equity return, which of course includes the impact of sector leverage. And 3. Excess leverage, which is the difference between the private equity deal's leverage-driven outperformance and the sector's leverage-driven outperformance. Now, you can prove that this is mathematically correct because each of these terms cancel out, giving you the private equity deal's total equity return that we started with. This does not always guarantee that an analysis is meaningful. There are many ways to make meaningless value drivers add up to the correct number, but I don't think that's the case here. The math is intuitive and it makes sense. The main drawback here is how complicated the formulas become. When you expand everything, you see that the private equity alpha formula is no treat, but that excess leverage formula, as defined in the 2013 Acharya paper, wow, that's even worse. This is quite a departure from the value bridge model, where excess gearing was just the change in the company's enterprise valuation times the excess debt ratio. Other considerations include the fact that many of these numbers are difficult to find, so they must be estimated, and that unlevered IRR formula that underlies everything in the analysis becomes volatile when companies are highly levered or when they experience large changes in debt. We won't prove that here, but go back to video VC 103 if you want to see how that plays out.